Good morning. It is August 5th, and the markets are down, and there's a lot of fear. The headlines, if you look and you see what all the different media outlets are saying, they're saying things like it's a bloodbath, market sell-off, market crashes. There's, what you want to know is that this is all very normal. The market is always going to have days like this, ups and downs, and media outlets, they tend to highlight and emphasize the fear. And a lot of times it creates more fear than necessary, for sure. And so markets are cyclical in nature. And what I would say is if you have unusual anxiety or fear because you're seeing the market down, to me, that suggests that you don't have a good plan. Because if you know your time horizon, you know your needs, you've got the proper diversification. When you've got all the pieces in place, you should be in a position where you're comfortable with some degree of volatility. And why do we even want any volatility or accept any volatility? It's generally because equities, stocks, have been and are one of the strongest hedges against inflation. But you have to be able to go with some of the ups and downs along the way. So this is very normal. Hope you're not feeling really anxious this morning. And so I just wanted to tell you just a few things. The interest rates are also dropping. And that's probably the bigger story here, is that interest rates are coming down, is providing or creating even more pressure on the Fed to make some rate cuts. So there's multiple rate cuts expected and coming down the wire here. And so there's pros and cons to that. It's not great if you're holding bonds because you're going to be losing some value there. But if you're looking to maybe finance or qualify for a home loan, for example, rates are likely to get better here down the road. So you just want to make sure that you don't let fear get in the way. Fear is what causes a lot of bad decisions. And from my experience, as we see those who have a long-term view, a stock market is always a long-term investment. You don't want to be thinking in real short term. And so you want to know that you've got a good plan. You want to know how much volatility you have. Volatility can be terrible if based on how much volatility you have, based on your time horizon. So generally speaking, those who I have seen do better with their investments are those who certainly don't panic and they have that long-term view. So hopefully this video, it's short, but I just wanted to come on and encourage you to have a good plan. If you don't feel like you have one, that would be the best thing we could possibly recommend, is to make sure you're well diversified. And a lot of times, if you focus only on market volatility, let's say a 10% drop in the market really stresses you out, but because maybe you haven't really put into place a good tax plan, you're going to be losing 30% in taxes. And so keeping a perspective and looking at all the pieces of a financial plan are really important. But the markets drop, the markets rebound. It's always a timing issue. When you've got at least 5 years, 10 years or more before you're going to need stock-based investments, then you have some ability to tolerate some ups and downs. So hopefully you found this helpful. I hope you have a wonderful day, and I look forward to seeing you in the next episode of the Financial Fast Lane.